Thank you for joining us today for our webinar, Know the Rules, Understand Retirement Plan Regulations Benefiting You and Your Company, hosted by Cranes Cleveland Business and presented by the Ahola Corporation. I'm Michelle Sestar with Cranes Cleveland Business. As a reminder, the presentation is being recorded and will be available to rewatch tomorrow, along with a download of the slide presentation. Watch your email for the link. The webinar will be 60 minutes, including a presentation from our speakers and a question and answer session. You can submit a question at any time throughout the webinar by typing it in the question field to the right of your screen. We will hold a Q&A session at the end where we will try to answer as many questions as possible. Our webinar today will be presented by Matt Loeffler and Jeff Ahola. Matt is the founder and CEO at Blue Tree Wealth Advisors. For the past 20 years, he has been assisting high net worth individuals in estate planning and investment management. He has been heavily involved in designing qualified and non-qualified retirement plans for corporations and nonprofit organizations. He has assisted entrepreneurs in their succession plan and the monetization of their closely held businesses. Jeff is the CEO at the Ahola Corporation, where he holds the primary responsibility for charting the strategic direction of the company his parents founded while fulfilling its mission to help other family businesses succeed. He also oversees Ahola's sales and marketing efforts, a role he has held since 1984 when he joined the family business. Under Jeff's leadership, the company has secured its marketplace position as a top provider of family-focused payroll and human capital management systems. I'll now pass it over to Matt and Jeff, who will get things started.
Thanks, Michelle. Jeff Ahola, folks, and good afternoon. We're going to spend the next 45 minutes and go through the following on our agenda. So we've got a quick review of the main stages of a family business. We're also going to focus on the three most common plans, and we're going to review plan limits. We're going to discuss the non-discrimination rules and requirements, a few 401k benefit examples, and then we're going to wrap up and then give you a few takeaways. So from our last webinar, if you were on the call, we were with Mary Eileen Vitale, and we discussed the stages of the family business that were most prevalent. So we whittled down the 5 most common stages and reduced it to the 3 most common that we think our audience is going to be interested in. Those stages would be the entrepreneurial or co-preneur stage, the parent-offspring phase, or the sibling partnership phase. Those 3, I think, are pretty much self-explanatory, but what we're going to get into today is a deeper dive into 3 most common retirement plans that fit the most common stages of a family business. So I'd like to turn over the presentation to Matt Loeffler.
Thanks, Jeff. Welcome, everyone. As Jeff mentioned, what we're going to do is focus on probably the 3 most common types of qualified retirement plans, and these are defined contribution plans. Depending upon where you are in the stage of your business evolution, some of these plans might be easier to implement and therefore better for you with regard to their effectiveness. The first one is the simple plan, and as you can see, it's an acronym for the Savings Incentive Match Plan for Employees. Probably not the most creative acronym developed by the IRS, but this is a type of plan that allows for voluntary salary deferrals, and also it requires a modest level of an employer contribution. Next is the SEP, which is the Simplified Employee Pension Plan. And a SEP is essentially a type of plan where the employer will make a contribution on behalf of his employees. There are no salary deferral options inside of a SEP. So this is really where the employer says, I want to provide a benefit to my employees, and therefore I'm going to have this type of plan where I will make an annual discretionary contribution. Worthy of note, with the simple plan and the SEP, the investment vehicle for those plans are IRAs. So IRAs are established for each of the participants in the plan, and that is utilized and established either by the employer or the employee for the purpose of receiving contributions. If we go to the third plan, the 401k plan, this offers a much larger contribution capacity, as well as more flexibility relative to contribution access, plan design, entry into the plan, etc. A 401k plan actually utilizes a qualified retirement trust, and that is different than the IRA that I mentioned for the simple and the SEP. If we think about these plans, the reason that you want to enact a retirement plan is because you are getting an income tax deduction for the contributions that you make to the plan, and you're receiving an income tax deferral on the investment earnings that go into the plan. So it really is one of the things that employers seek as a benefit to their employees as well as to themselves. And if we go to the next slide, you can see the different limits. So when we talk about the simple, the salary deferral limit for the calendar year 2018 is $12,500. That's the portion that the employee chooses. How much do I want to contribute out of my pay for my own retirement savings? The employer contribution under a simple plan is a required contribution, and it's one of two formulas, either a dollar for dollar match up to 3% of compensation, or it's 2% of everyone's or all eligible employees' compensation. Under the SEP, as I mentioned before, the only contribution that goes in is what the employer chooses. And we'll talk a little bit about how the allocation is determined, but an employer can contribute up to 25% of an eligible employee's compensation to a maximum dollar amount of $55,000. And then we go to the 401k. And the 401k, you can see, has an increased salary deferral amount. So the simple is $12,500. The 401k is $18,500, or $6,000 more a year can go in there. The employer contribution can be stated or it can be discretionary. So you have a lot of flexibility. If the employer says, right now I just want to open up a plan to allow my employees to make salary deferrals, they can do that. But if you want to encourage larger participation or provide a larger benefit, then you want to provide a type of contribution. The most common type is what they call a matching contribution. And so that can be a dollar for dollar match. It could be 50 cents on the dollar. It could be a lot of other things. In addition to that, the employer can then say, after they've made their matching contribution during the year, they can put in another discretionary contribution, which could be another 2%, 3%, 4% of each eligible employee's compensation. One other note on this page is about 15 years ago, the IRS expanded the opportunity for people to save. They started to realize that people were behind their savings levels to have a proper retirement. So they added a catch-up contribution provision to the code. Under the simple plan, a person age 50 or older can add another $3,000 a year. Under a 401k plan, that catch-up contribution is an additional $6,000. So if you're 50 or older and you have a 401k plan, you can actually contribute $24,500. All right. So we'll talk about each of the plans on the following slides. The simple plan is utilized by an employer who has less than 100 employees. And one of the overarching themes that you will hear us talk about is, how do you count an employee? How do you categorize employees? What makes an employee eligible, et cetera? How do we get people into the plan? The simple plan, because they circumvent the non-discrimination requirements, it is easily activated through filing a Form 5304 Simple or a 5305. The difference in that designation is that a 5304 Simple plan is utilized by an employer who will allow the employee to choose their IRA custodian.
Matt, is that an annual filing or a one-time filing?
That is a one-time filing.
Okay.
So the 5304, once they file that, it essentially serves as the plan document for the Simple plan.
Got it.
Right? Which is a little bit more complex when we get to the 401k plan. So who has to participate, or who is allowed to participate in the Simple plan? Essentially, it's an employee who earned at least $5,000 in the preceding 2 calendar years. And the other requirement, as we mentioned before, is the contribution requirement. Dollar for dollar match up to 3%. Again, if you don't contribute any money into the plan, or a participant does not contribute, they do not receive the matching contribution. Or you can contribute 2% of every eligible employee's compensation. As I said, the reason there is simplicity in this structure is because there is no annual compliance testing. The only thing you need to provide is an annual notice to the employees indicating that they have the ability to defer into the plan, the type of contribution that you're going to make, and how to basically to get their IRA established. One thing to note is that contributions that go into this plan are 100% vested as soon as they're made. In a 401k plan, we'll talk a little bit more about how a vesting, a sliding scale vesting, might be more appropriate for some other plan sponsors. On the next slide, we'll talk about the SEP. Probably the easiest plan to administer. It can be established by an employer of any size, so there's no employee headcount to say who can adopt a SEP. In addition, there's no organizational structure that would limit someone from implementing a SEP. So for example, if you're a C Corp, or you're a sole proprietor, or you're in a partnership, you can have a SEP. There is no limitation relative to organizational structure or employee base.
Including S Corps as well?
Including S Corps, correct.
Right.
Correct. And so the plan, similar to the simple plan, is activated through filing Form 5305. Okay, it's one form. And again, this serves as your plan document. Now, the eligibility requirements for employees as to who is eligible to receive a contribution is a little bit more complex because you have three requirements. And that is, number one, they have to be age 21 or over. They had to have worked for the employer for 3 out of the past 5 years. And they had to have made at least $600 annually. So if you hit the trifecta on that whole eligibility requirement, you can bring an employee into the plan and make a contribution on their behalf. You can always make those restrictions less restrictive. In other words, you could say that you want to bring in employees who are 19 or 20. You could put in people who make under $600. You could put in people who haven't worked 3 out of the 5 years. The more flexible you are, that is up to you, but you have to be consistent with the implementation of those requirements.
Can you put your spouse and your children, if you're a family organization, on the simple plan?
Absolutely. There is,
with no family attribution rules or no
correct,
discrimination regs to worry about, correct?
Great question. And then,
okay,
so we're going to talk more about family attribution rules, but the one thing to consider here is that you do not have the complexity of dealing with family attribution as well as some of the non-discrimination rules that go along with that.
Okay, great. Okay.
One thing I'll just mention, let me give you an example here with regard to contribution allocation. So for example, if you're an employer, and let's assume your total payroll is $500,000. Out of that $500,000, your compensation as the business owner is $200,000. And you come to the end of the year and you say, I have $50,000, I would like to contribute it to myself. How much would the employer get? Well, 200 divided by 500 is 40%. So you would get 40% of that $50,000 or $20,000 would go into your portion of the SEP, into your IRA as the business owner. The remaining $30,000 would be allocated pro rata among the rest of the eligible employees.
Right. Okay.
Okay.
All right.
All right. On the next slide, the 401k plan. So this is where we start to shift gears and become a little bit more flexible and probably a little bit more exotic in plan design. But what it really does is it takes the best attributes of the simple and the SEP with allowing for salary deferrals and then allowing for the maximum employer contribution. If you look at the way that the maximum annual amount is addressed down below, you have the maximum deferral amount for 2018 of $18,500. Then you can add on the catch-up contribution, and then you can fill in the gap up to a limit for the employer discretionary contribution and or matching contribution, so that the annual maximum amount for a participant is $55,000 up to 25% of their compensation. If they are 50 or older, because of the catch-up contribution provision, that would go all the way up to $61,000. Now, to note, why, when you think about limitations on this, the reason that the IRS prescribes a limitation is because obviously they want to tax as much as they can currently, because they have, obviously we run a deficit, and so we want to be able to get that tax revenue in there. The reason they allow for this type of plan is they say they understand that Social Security is not going to be the primary source of income during retirement. When you look at the limits themselves, what they do in their own studies is they say, based upon those levels, how much or how many people as a percentage of the working population would be able to be comfortable in retirement with those types of limits if they would go all the way to the maximum. And that accounts for about 95% of the workforce in our economy, right there. Now, there are people who make a lot more money, and there are other plans that are set up for those people. But this is just something to think about as to why those limits are in place. It's not just done from a standpoint of, well, that seems like a good dollar amount. It's more about how do we get people ready for retirement. The one thing to think about, again, are the discretionary bases for the employer contributions. It really comes into play big time for employers who say, I'm not sure what my year is going to look like, and I know I want to reward my good employees. I want to reward my workforce along with myself, but that really comes into play. If we go to the next slide, let's talk about some of these provisions. So unlike the simple and the SEP, you can implement your own age requirements or what we call eligibility requirements, and then you have service requirements that determine who is eligible, what is vesting, who should receive a contribution, and that's based upon hours of service. So again, we go back to the head count type of approach, where we say who technically is an employee, who becomes an eligible employee, and what do they have to do to satisfy that eligibility requirement. So a lot of detail can go into one or a few different plan provisions. So eligibility, the most common type that I see is 1 year of service and age 21. So once you complete 1 year of service, you can come into the plan and you are age 21.
And those newer employees are looking for a 401k plan as part of their benefits package.
Correct.
And with the tight labor market, it's pretty important that you satisfy as many needs as you possibly can.
Exactly.
Great.
Correct. That's a great point, Jeff. And with regard to vesting, vesting represents ownership of a benefit that is paid into the plan. So if you're contributing a matching contribution, that's wonderful, but if you have a 6-year vesting schedule, that means that the employee who received that contribution will not own that contribution until they've completed 6 years of service. There are several different types of vesting schedule. And then we go into withdrawals. You know, when can people take their money out of the plan? Can they take money out of the plan while they're working? Do they have to wait until they're age 65? Is there anything in between there? Loans. Some of you may have heard this, but you can borrow from your own retirement account. And to do that can be, kind of a different avenue for some people that say, I need the money now. I understand I have to pay myself back. Otherwise it becomes a taxable event. But these are all provisions that can be implemented in this type of plan design, along with how much can an employee contribute through the salary deferral arrangement, what can they invest in, et cetera, on down the line. The important point about all of this is when you have plan provisions, how do you communicate them to your employee base? It is one of the most complex features about having a retirement plan, because if you want your employees to have a perceived benefit, most people will look at a statement and say, I have this much money, but I know I can't touch it, and therefore they minimize the impact of it. And so while you go through the implementation of this plan, or as you continue in the maintenance of your retirement plan, you want to be able to explain how the plan operates and the benefit that they're getting, the benefit that you're contributing on their behalf, and how you're looking out for them. I'm going to turn this over to Jeff for the next slide so he can talk to you about the Human Capital Management Platform and how that can help communicate some of the plan provisions.
Thanks, Matt. So what we're talking about here is HCM is the current term for human capital management. So it's a platform or a technology tool from hire to retire. And so as Ahola moves from being, a payroll company to a payroll-based human capital management company, the 401k provisions are perfect for describing the values of having one database for all of the major employment data. So for example, in a 401k plan, you need to show that summary plan description's been given to your employees, and there's ways to post that on a portal where the employee gathers their pay stub information, where they connect to their 401k vendor, where they request their time off. It's all one home base that employees go to when they're on our human capital management platform. The links directly to the plan provisions, links to perhaps how do I obtain a loan on my 401k plan? I'm buying my first home. Is there ways to get these things done uniquely? Those are all part of the human capital management platform at Ahola. On the employer side, transferring the funds as well as calculating the match and handling some of the loan provisions, those are done automatically once we link up to the TPA or the third-party administrator of the 401k plan. So it pretty much becomes hands-off for the client if the HCM platform vendor has got those links already taken care of. So a very important part of the process of managing the 401k in this environment. Employee self-service, SPD document storage, those are critical when the Department of Labor comes in for a random audit. They want to look to make sure you're communicating to your employees the plan's benefits. Are you giving them good education? Because there's requirements on these plans that are pretty stiff and pretty important. So these are the type of benefits, employee benefits, that are managed in a human capital management platform in today's technology. And in it we integrate all the employee benefits, not just the the 401k. There's other employee benefits. Perhaps there's a health savings account or a Section 125 plan or a traditional, major medical plan. Those things are all now in one database tied to the payroll system. So as for the 401k annual filings, there's a 5,500 return, right, Matt?
That's correct.
So that information is pretty important, and a newer concept that's available in the marketplace from certain vendors is a 401k multiple employer plan. There are closed multiple employer plans, there are open multiple employer plans, but that is an option that you can consider, and it is just like a traditional 401k plan, but it's being administered, and people adopt into an existing plan, and we'd be happy to talk to you about that further if you have more questions on that. But I'll turn over the presentation to Matt to talk a little bit more about the annual filings, some of the discrimination regs, and some other issues that are very important on the 401k side.
Thanks, Jeff. So as Jeff mentioned, outside of the multiple employer plan adoption, most plan sponsors will have an individual plan that really only satisfies their workforce. And with that, you have a number of filings that go with the 401k plan. Again, just the 401k plan, not the simple and not the SEP. The one annual requirement is that an IRS Form 5500 is filed. And what that does is it's an informational return, and it talks about some of the plan provisions, but more importantly about the contributions, the asset base of the plan, what is the employer contributing, what have the employees contributed. It allows them to keep track on the growth of the plan, okay? Should you adopt, and we'll talk a little bit more about a safe harbor notice or a safe harbor plan through an example, but a safe harbor notice, if that provision was adopted in the plan, this indicates that what is that contribution going to be? And it usually has to be provided within 30 or 60 days before the plan year. And it indicates what benefit is going to be provided for the next plan year. So there has to be a notification of that. The summary annual report, sometimes I think, I just resigned from an employer back in March, and I think I'll get a summary annual report on that 401k plan for the rest of my life, because it has to be provided to all participants and beneficiaries, just indicating some of the basic plan information. And then a participant statement. Most things are electronic these days. You're able to log into your account, see your balance. Believe it or not, I remember the time, and I guess I'm dating myself, when these used to be what they call balance forward. So you wouldn't see how your assets performed until the end of a calendar year or a plan year. And that was only about 20 years ago. And I say that, mockingly at myself.
But you can roll over these individual IRAs and 401ks into a new plan that's already been established.
That's correct.
Well.
Yeah, so along those lines, I mean, if someone said, well, I have this plan right now and I'd like to go into a different type of plan, most plans now under the Pension Portability Act can be merged, or basically you're just transferring the assets and starting a new plan, essentially. Again, you want to contact an appropriate third-party administrator like Jeff's firm to have that type of conversation and talk about that. The other thing I want to note, and it kind of goes back to what Jeff was talking about with the Human Capital Management Platform, is an ERISA 338 notice. An ERISA 338 notice is for plan sponsors who say, look, I want to have a retirement plan, I have a large workforce, I'm not comfortable understanding how much I need to educate them on the investments. And that probably is the biggest area of liability concern on behalf of a plan sponsor. Well, an ERISA 338 allows you to essentially transfer some of your liability. I don't think any plan sponsor is ever away from all liability, but it allows you to transfer some of the liability where a third-party administrative firm says, I will take care of that for you. I will educate your participants on the investments and the plan provisions, and that helps kind of ease the pain and also elevates the communication message, as I mentioned, about the benefits. So it is so important to have that third-party administrator firm. I can't tell you how many plans really just aren't perceived as benefits, and that's just a shame for the amount of effort, money that goes into it on behalf of a plan sponsor.
Mm-hmm.
Okay. On the following page, we'll talk about the non-discrimination rules, and I'm going to say this is kind of a summary overview, but it's worthy of noting what rules apply to a 401k plan that make them a little bit more complex. The first one is what they call the average deferral percentage test, or the ADP test. What this essentially does is it limits what a highly compensated employee, usually a business owner or a group of executives in the plan, it limits how much they can contribute to the plan on an annual basis. And here's how the test is run. You take the group of highly compensated employees. Let's assume you're in a business and your employee base is 50, and then there's the business owner, the CFO, and the business owner's spouse. There's 3 highly compensated employees in that group. They cannot defer more than 2% of the average of the rest of the workforce. So if your workforce is only contributing, on average, 4% of their compensation, the highly compensated employees can only contribute 6%, okay? That is a limit, and I will tell you, the frustrating part about this is when people start a 401k plan those first 3 years and are not aware of this rule, and I've seen this, where money has to get returned to the highly compensated employees.
Yeah, we see that a lot in family businesses where the family owners that are active in the business are considered key employees, HCEs, highly compensated employees, or through family attribution are considered the same. And the problem with that on the payroll side is we have to go back and do a W-2C, which is a corrected W-2 for the employee, because if the owners have been overly benefited by the 401k plan, they have to give the money back to the plan and redistribute it to the other, those that have been discriminated against. So you've got multiple payroll problems that happen, and it's usually in January or February when people are trying to file the returns, and it creates a cascading effect of problems, especially for family companies that have a lot of family involvement. So, very important part of the process.
It really is. And so we're going to talk on the next slide about the, the highly compensated employees. Who is a highly compensated employee? Because the one thing to keep in mind, and as Jeff's firm can really help out here, this is the proactive part of planning. When you are in this situation and you're not sure who's going to be a highly compensated employee, you want to do some proactive testing and get that data in, because anything can change at compensation level, ownership levels, right? Family members coming into the business, those things evolve, and they can evolve quickly and put your plan out of whack.
And a lot of them have a look back period tied to them too. So the previous
correct.
year's compensation is an important part of that. So
that's correct. Now the next one is the top heavy test. The top heavy test, now we have a new definition with this. So we had highly compensated employee under the average deferral percentage test. We have key employees under a top heavy test. A top heavy plan is when 60% or more of the plan benefits are skewed in the hands of key employees, okay? This is one of the elements, again, when you start a plan, you probably don't have much of a problem with that because you have a workforce, everybody's receiving a benefit, but over time, the more highly compensated and the ownership category of a plan evolves to own more of the plan assets. When that happens, because it is top heavy, or if it becomes top heavy, you, as a plan sponsor, may be required to make additional contributions on behalf of the rest of the employees. Now, that doesn't sound like a horrible thing, except for when you are going through a tight budget on an annual basis and you're hit with, oh, hey, you have to make a 3% minimum top-heavy contribution, people are a little shell-shocked by that. So that's something to think about. And again, this goes back to my idea of proactive planning on a calendar year basis. And the final one, the minimum coverage requirement, is essentially this. If you're providing a benefit to all of your eligible employees, you can't pick the employees you want to benefit more or less. Okay, so in other words, if you have employees, you have employee A and they're a stellar employee and you want to contribute $10,000 to their account, employee B you're not too happy with and you want to contribute $0, you can't do that because it would fail the minimum coverage requirement. The minimum coverage requirement really applies to the employer contribution, and 70% of the employee base has to benefit from that and some ratio of equivalency across the board. The testing for this can be fairly complex, depending upon how much you want to change or have variable contribution allocations in your plan. So just understand that that exists. I will tell you most prototype plans automatically satisfy minimum coverage by design. So,
and that test is called the ACP test, the actual contribution percentage.
Correct.
And that's where the ADP and the ACP test are the two most common testing requirements. One of the interesting things that family businesses got a little relief from the IRS and the Department of Labor was the elimination of the family aggregation rules. And what family aggregation rules were complexities for families that if you were an owner of a business and you employed your parent and or your child, you have to aggregate all of those earnings from your payroll as if it was one highly compensated employee.
That's correct.
And it really skewed quite a few things. So thank God we've got some changes done in the DOL and the Department of Labor and IRS on some of these plan documents, because it's complicated enough as it is for everybody, but it's more complex for family companies.
Yeah, suffice it to say that the family aggregation rules were repealed in the late 90s, and it was very prohibitive for a lot of business owners to make the maximum or even the desired level of 401k salary deferrals. Now, on the next page, we're going to talk about those categories. What is a highly compensated employee? What is a key employee? So we have IRS definitions for these. So a highly compensated employee is an owner of more than 5% of the company during the current or preceding year. So again, we sometimes deal with a look back. It's not just what's happening in the current year. We have to look back. Or it is a person earning more than $120,000 in 2017. That's the preceding year that we're in. So we're in 2018. We'd have to look back to 2017 to figure out the compensation limit. And this is the important part, right, Jeff, the family attribution rules. Any spouse, lineal ascendants or lineal descendants of the highly compensated employee. So when you think about the highly compensated workforce, if you just started your own business and you have 3 employees, it's probably pretty simple. You're the highly compensated employee. But as your business grows and you bring in family members, you have to understand that those family members generally, well, you have to look at the relationship, but generally will be considered highly compensated employees. It could affect the benefits that you are trying to achieve for yourself and for everyone else. Now, that is for the average deferral percentage test. That's the highly compensated employee definition. When we go to the top-heavy test, the other one that I mentioned in the previous slide, we have a new definition called a key employee. And so who is a key employee? A key employee is an officer with earnings more than $175,000 in the prior plan year, or an owner of more than 5% of the company. So a key employee and a highly compensated, you have that 5% ownership threshold. Or a 1% owner of the company who makes more than $150,000, and again, we add on the family attribution of any spouse, lineal ascendants, or lineal descendants of the key employee. So as I said before, these definitions evolve as compensation limits change on an annual basis. Ownership levels haven't changed, at least now. If I go back 20 years, I haven't seen a percentage change relative to ownership under the highly compensated employee definition or key employee definition, but they could. And
yeah, it's typically been 2% or greater if you're an S Corp owner or related party, and 5% or greater if you're a C Corp owner or provider. And those limits have stayed constant over the years.
Yeah. Yep.
Awesome.
And so when you think, again, as I indicate, the evolving method of this and all of the different parameters, Jeff is going to talk to you about all of the different types of parties that come, into your business and what they do and where they are.
Yeah, we're going to talk a little bit about role-based security in a family company in a human capital management platform. So this 3-circle model of family business that you see, the 3 overlapping and interlocking circles, was pioneered by John Davis at Harvard, and it helps explain the complexity of a family business. So when you look at the 3 circles, you've got a business system, you've got a family system, and you have an ownership system. In the early phase of a family company, it may just be a family system and a business system where the family, their IPO was initial parental output. They started the family company and there was no other capital. It was all done through, taking care of sacrifices to get the business started. So this model here is great to explain to people that don't have the experience. We got the Blue Angels in the background there, guys. So, the role-based security screen, or the 3-circle model, is wonderful to take snapshots of a business involvement over time. What Ahola has done is we've built in our security down to the field level based on what role the participant that has access to the data plays. So, for example, if someone's a 7 code, they're an owner, they're in the family, and they work in the business, and we have ways to set up the security for what they can view in the system and what they cannot view. But in most cases, that individual has access to all the data. Third-party advisors, 401k vendors, TPAs, lawyers, anybody else involved in the business would be a code 8. So we do a lot of interesting things on getting that set up. That being said, describing the roles, and if you look on the next screen, we've created a very unique financial genogram of a family business. And what this describes to you, if you can take a look at the processes, we are trying to describe what family attribution rules are. And they impact not only employee benefits like 401k plans, but they impact other IRS transactions that your accountants and your key lawyers will be privy to. But we want you to understand a little bit more about what family attribution rules are all about. So if you look at this sample genogram, and a genogram is a fancy term, but it's a genealogical diagram of the family business system. Just like an org chart is a chart of the organization, and we use an org chart to help us set up our security measures in the system, but a genogram is to help people involved in the family business to understand all the nuances as they change and grow through family involvement. So if you take a look at the next screen, you'll see that we've identified one individual, and as time goes by, you can see their involvement. So if you click to the next screen, you'll see a parent-child environment where we've got a founder, a grandfather, and a grandson all working together. What that means is a lineal ascendant is somebody on a not a horizontal line, but a vertical line. So if you were a sibling partnership where you had 3 brothers working together and a sister like Ahola, you know, that attribution does not affect that current generation. But when the children of those siblings get involved, that's when it gets more complex and dicey. So when you think about family attribution, think along bloodlines. And bloodlines today they're clouded with the new model of today's American family, with step families, stepchildren. You've always had adoption, but the IRS looks at adoptive and stepchildren with unique rules. So just be aware that these family attribution rules exist, and there's people out there that can help you understand these rules and better communicate how they impact things like your employee benefits. So I'm going to turn things over to Matt now to talk about some examples of some of these family involvements.
Can we just go back one minute? Because, Jeff, I find this so interesting because the extrapolation of those different roles and the combination of roles, you know, where they kind of intermesh, right? Where you're saying, okay, well, we have a family member, we have an owner, we have somebody who's actively employed. It really cascades through so many different types of government-regulated benefits, right? So today we're just talking about retirement plans, but tomorrow it could affect your health care coverage.
Health savings accounts, Section 125 plans, especially when a corporation changes its status. So now we've got businesses that started out as a sole proprietor. They may move to a C Corp status. They may have elected S Corp status, but once they change S Corp status, they may be ineligible for certain employee benefit plans. Like, for example, you can't have your earnings flow through as an S Corp and be on the health insurance plan and write off that tax deductible transaction. So we've seen that over the years of being in this business for 50 years, as companies and families and businesses evolve and their tax status changes, managing that proactively is a great challenge that we're trying to do more and more of that. So 401k is where most people realize the discrimination regs and the family attribution rules and understand that, wow, I didn't realize family business had some extra complexity tied to it, but we certainly do.
Yeah, I find it amazing that Ahola is able to captivate some of this information and mesh it and say, okay, based upon this type of account, we're able to advise you in the direction that you need to work, you know, to achieve your maximum efficiency and best benefit
and
relative
compliance.
And compliance. It's just, yeah, it's extraordinary. Great job, Jeff.
Thank you.
Okay, on the next page, we have an example. And so, you know, in the next 5 minutes or less, I just kind of want to go through and explain to you, you know, kind of a typical case that I've seen business owners. And so I'll give you, kind of read through the assumptions so that we can understand how we're starting this. But let's assume we have a business owner, and this business owner's compensation is $350,000, and that person is age 59. And the business owner employs his 27-year-old daughter. So went to college, got a master's, and is now going to be the CFO of the company and is going to earn $80,000 annually. Now, in addition to that, he has 24 unrelated employees, and their average age is 34 years old. with average earnings of $50,000. Some are higher, some are lower, but that is the average. And on an annual basis, that average workforce contributes 4% of their pay into a 401k plan. So that's kind of the baseline data set that we can utilize to go through two different solution sets. But here are the considerations that I often have heard from business owners. Number one, the employer wants the capability to defer as much as possible. In other words, they may not be there for much more than 5-10 years, but they want to be able to get as much in that they can. But more importantly, sometimes it is the effort to make sure that their lineal descendants can defer as much as possible as well. All right, so the daughter now being 27 years old, the employer wants the daughter to get off to a good retirement savings start, create their own liquidity pool, so that when they exit the business, they have some substantial wealth to be able to draw from. And then the employer wants to have the capability to make additional contributions to his loyal workforce. Not that he has to do it every year, but he wants to have the ability to do it in the years that are good. Okay, so let's go to the next slide.
And one little point on that too, the confidentiality of that data when a founder's generation is trying to ramp up their deferrals is a very sensitive confidentiality issue, because most people that would take a look at that going, wow, why is this individual earning so much money? Well, they weren't there for the 30 years they sacrificed along the path. And that's why we put on the role-based security is to keep that information away from prying eyes. So it's very important, especially when these plans are really ramping up at the end of a stage, converting from one stage to another stage in the family business. So
that makes sense, Jeff. So under this example, now we're just going with the regs as they are and no other added exotic provisions. But the business owner and the daughter are going to be limited as to how much they can defer through the 401k plan. So remember I talked to you about the average deferral percentage test. In this case, because the workforce average deferral rate is 4%, the daughter and the business owner are limited to deferring 6% of their compensation. Now, the business owner, not so bad, can contribute $16,500. There is an IRS maximum compensation limit, another threshold hurdle that we have to consider here. Even though he made $350,000, the IRS says you can only consider the first $275,000 as compensation. So that actually increases his deferral rate. Okay, but the daughter limiting herself to 6% of $80,000 means that she can only defer $4,800. And without this regulation, the daughter would be able to defer $18,500. So we have close to a $14,000 retirement savings airball right here. And that's where you say, okay, well, what can I do? I mean, these are the rules. Tell me what I can do. Now, down below in the lower left, there is the safe harbor contribution. So I alluded to this before, and this is what a lot of plans have enacted. What it is basically saying is if you make one of two types of contributions, fairly modest contributions, it gives you a baseline benefit that you're providing for all of your participants, all of your employees. And it's based upon a 3% eligible participant compensation. So in other words, whatever the eligible participants make, you are contributing 3% of that on an annual basis to the retirement plan on their behalf. Or you can do a matching contribution. And the matching contribution is dollar for dollar on the first 3% of compensation, and then 50 cents on the next 2% of compensation. Okay, now think about that for a minute. What does that really mean? Well, really, anybody who contributes 5% of their salary, they're going to get 4% in the form of a matching contribution, okay? Mm-hmm. So where you look at this as an employer, you say to yourself, do I want to encourage someone to save? Of course you do. Is the matching contribution going to be an inducement to save for retirement? There's a lot of facts out there that indicate yes, it is. So you would use the matching contribution. However, if you said, you know, regardless of what they do, I want to provide them a benefit nonetheless. So I'll just go to the non-elective discretionary contribution of 3% for all. That's a choice the employer can make. So those are the kind of the considerations that go along those lines. But let's assume that now this employer adopts one of those safe harbor contributions, and we'll go to the next slide. Okay. In this case, the second bullet, the business owner elected to make the 3% safe harbor uniform contribution. That amount, again, based upon the compensation, 3% of the payroll compensation is $36,000. Okay. And then it's a good year for the employer. And the employer says, I want to make another additional discretionary contribution of $50,000. So right now, as it stands, the employer has made a total contribution of $86,000. Again, $36,000 being being the safe harbor, and $50,000 being in addition. So how does this shake out for the business owner and his daughter? If you look to the right, if you look at the pie chart, we have a 58-42 pie chart. 42% of that $86,000 goes to the employer. So that is a really nice feature. Now think about that. The business owner is going to receive the 42%, is going to receive $36,000 on their own. Now, this is subject to a different plan design feature called an age-weighted allocation formula, right? In other words, the older you are, the closer you are to retirement. And the regs will allow older people in a retirement plan, because they have less time to save, to receive a larger piece of the overall profit-sharing pie, so to speak, all right? Okay. The other side of this, though, is that the daughter now, because there is no average deferral percentage test, we eliminated that with the implementation of the safe harbor contribution of 3%, which is immediately vested. The daughter now can contribute $18,500. So she went from $4,800 to $18,500. A nice bump for her to be able to save all that money. And in addition, think about how much money the employees are receiving well, right? So 58% of $86,000, right? Mm-hmm. Roughly a total allocation of $50,000. What a nice benefit the employees are receiving. And in a properly communicated plan, that is something the employer can go to the workforce and say, I really want you to understand, it's not just your compensation, it's not just your health care, but it is also this retirement plan that I am helping you with. Mm-hmm. Those are the things that I think a good plan sponsor wants to quantify, and wants his employees to recognize.
Great, Matt, that's great. Matt, one quick question about a family that may own multiple corporations. Right. So let's say they have 3 companies set up for whatever purpose. If they offer a, you called it a mandatory or a safe harbor contribution, do they have to offer that safe harbor to all other companies that they may have in what's called the control group, or can they have custom plans for each company?
Generally, yes. So what you have to do is you have to look at the control group status, and there's 2 types. There's a parent subsidiary and there's a brother sister. And so you have to go through that type of analysis. Now, once you get through the non-discrimination the rules and applying that, and it kind of comes down to what I mentioned before, the minimum coverage requirement. It depends on how many employees you have in each company
and the calculation
as to the benefit that you would have to provide to those other control group members.
Yeah.
But that's a great question.
Yeah, we see a lot of family companies end up creating more than one company, and they don't realize, like in the Affordable Care Act provisions, a control group, if you own a major share of these other corporations, you've got to comply and offer the same benefits to all those employees.
And so we talked about headcount, Jeff, as kind of the premier driver for, how do we say we have so many employees? How do we indicate which employees are who, with key employees highly compensated? The one thing I will tell you with qualified retirement plans is the only statutory exclusions you have are those that are represented by a collective bargaining agreement and non-resident aliens, right? So those are the ones you can exclude. When you get into, again, the control group, you have to start looking at that. And sometimes this even comes up, you have leased employees. Leased employees are temporary employees, but you have to include those. And I've been in situations where I'll tell you, it was back probably almost 10 years ago when a physician group acquired basically a prescription data firm, right, with about 50 employees, and they didn't realize now that they had to make contributions on behalf of those employees, even though they weren't under the direct control and supervision of the other physician group.
They're part of the control group.
Yeah.
Awesome stuff. Yeah. Great. Well, I think we're at the next slide here, where if you'd like to continue the conversation about how these rules and regulations and stipulations can be navigated and keep you in compliance, we'd like to invite you to the Crane's Family Business Forum on September 12th at Corporate College East. So we will be there, and we'd be happy to help you with any other questions you may have.
Do we have any questions out there?
Good. Please feel free to send in your questions right now. You can type it into the field to the right of your screen. If you have any questions for Jeff and Matt, we have a couple minutes to answer them.
Before we get any more questions, one of the common questions is the cost of these plans. So can you summarize what the kind of costs are on the plan, setting it up,
Sure.
creating the documents, when lawyers are involved and some other people are involved.
So relative to the three plans we talked about, the simple, the SEP, and the 401k plan, the simple and the SEP will have virtually no startup cost.
Okay.
It just depends if you say, well, I don't want to fill out the form. I have to
want
establish the IRAs. I want to pay
compliance,
somebody to do it. Okay,
Yeah.
that's kind of a discretionary type of expense. So simple and SEP, very low hurdle of upfront expenses. 401k plan, if you're using a prototype document, you're going to have minimal startup costs. But I would ballpark, and again, I'm talking about a workforce of anywhere from 30 on up. To have a prototype plan, set up the investment platform, et cetera, you're going to have a few $1,000s of startup costs.
Mhm.
Okay, now there is a tax credit that was enacted that for small businesses starting a retirement plan.
Yep.
So that was something that was new in the last tax bill. So that could be helpful. But the more exotic you get, right? Keep this in mind. So if you say, well, Matt, that age-weighted formula you mentioned towards the end, or something along those lines, or we're getting into control group situations, you're going to have more of a startup cost because your plan is going to have to be a little bit more hard-coded to recognize the specifics of that particular plan sponsor.
Yeah, it's the maximum amount of benefit is really valuable when you take the effort to start the plan and get the assets to grow, because there's cost embedded in managing the assets by those people that look over those investments. And the larger that pool of money gets, the lesser the cost gets to be. So,
and just for the audience out there, I mean, one of the things, if you're thinking about starting a plan and you're looking at your demographics and you're saying, boy, I really would like to see how much I could really do here is with regard to tax deferred savings, please contact us, Jeff or me, and we would like to meet with you and talk about just how your data looks and what you would be capable of sponsoring.
Great.
Any questions, Michelle?
No.
All right. Well,
Okay.
You guys answered every question during today's presentation.
Great.
All right, you guys. Thank you so much for your participation in today's webinar. If you have a topic or are interested in a sponsorship opportunity, please feel free to reach out to me. My name is Michelle Sestar. My information will be in the follow-up email. If you'd like to revisit this presentation, the webinar will be available on demand in the next few days, and you will get an email notice when it's ready. Be sure to watch out for that email notice. We will also have further information on the upcoming Family Business Forum and a special deal for the folks who attended today's webinar. On behalf of Cranes Cleveland Business and the Ahola Corporation, I would like to thank you for attending. Have a great afternoon.